Gold just hit an all-time high. Then it did it again the following week, then again the week after that. For 18 consecutive months, this has been happening so consistently that professional traders have basically stopped trying to explain it. Financial media keeps throwing out the usual reasons: inflation, geopolitical tension, weak dollar, and none of them fully add up. But here is what is actually happening, and it is bigger, more important, and more relevant to your money than anything you have heard about gold before. Because this is not a story about a shiny metal. This is a story about game theory, institutional trust, and what happens when the world's most powerful financial players quietly start preparing for a future that looks nothing like the past. Let's get into it. For 80 years, the global financial system has operated like a game of musical chairs, and the US dollar has been the only chair everyone wanted. Every country needed dollars to buy oil, to settle international trade, to store their national reserves. It was the safest, most liquid, most trusted seat in the room. The game worked perfectly as long as everyone believed the chair would always be there. But here's the thing about trust. The moment even a small number of players start quietly doubting, the whole room gets nervous. And when that happens, institutions start looking for a chair that nobody can ever take away from them. That chair is gold. And right now, the data shows the largest sustained move into gold by central banks and major institutions in recorded history. The question is why, and the answer should get your full attention. Let us start with the hard numbers, because they tell the story better than anything else. In 2001, central banks globally held around 66% of their foreign exchange reserves in US dollars. Today, that number is 58%. An 8-point drop over 25 years sounds modest until you realize we're talking about trillions of dollars shifting, the largest sustained move away from dollar reserves since the modern financial system was established. And where is that money going? Into gold. In 2022, central banks purchased just over 1,000 metric tons of gold. In 2023, they bought 1,040 metric tons. In 2024, they purchased 1,184 metric tons, the highest annual purchase ever recorded in history. According to the World Gold Council, 41% of central banks plan to increase their gold holdings in the next 12 months. Only 1% plan to reduce them. These are not the numbers of a system operating with full confidence. These are the numbers of institutions running a very serious and very quiet fire drill. To understand why this is happening, you need to understand one specific moment that changed the thinking of financial institutions across the entire world. In 2022, approximately $300 billion in foreign currency reserves were frozen as a consequence of geopolitical conflict. The reserves belonged to a sovereign nation. They were held inside the international financial system, and they became completely inaccessible overnight. Now, regardless of any political position on those events, every other country on Earth watched that happen and absorbed one critical lesson. Reserves held inside another country's financial system can be frozen. If the political relationship changes, the money becomes unreachable. It doesn't matter if you agree with the decision. What matters is that it is possible. And once something becomes possible, every rational institution in the world has to plan for it. Countries holding trillions in foreign reserves started asking their economists one very specific question. What is the one asset we can hold that no foreign government can freeze, sanction, or seize? The answer is physical gold stored on your own soil. That is why central bank gold buying accelerated dramatically from 2022 onwards, not because of inflation, because of game theory. Here's where the story gets even more interesting. Some countries are reporting modest official gold purchases through their central banks, but when you examine actual physical gold import data flowing through major trading hubs, the real numbers are dramatically higher, in some cases nearly 4 times what is being officially reported.
This is not hidden exactly. The import data is publicly available to anyone who looks, but it is not being advertised either, because the last thing any major economy wants to do is signal loudly to global markets that they are preparing for a post-dollar world. That announcement alone could trigger the exact crisis they're trying to quietly hedge against. So, instead, they do what sophisticated institutions always do. They move slowly, consistently, month after month, quarter after quarter, reducing dollar exposure and accumulating gold without ever making a headline about it. Poland bought more gold in a single recent year than it had purchased in the previous 2 decades combined. India's central bank added significant tonnage in just the first quarter of 2026. Turkey now holds gold as over 30% of its total national reserves, up from almost nothing a decade ago. This is a global institutional trend, and most retail investors have absolutely no idea it's happening. Here's the thing that confuses most people. Gold and stocks are both at record highs simultaneously. Historically, that doesn't happen. When investors feel confident about growth, they buy stocks and real estate. When they're concerned about the future, they buy gold and bonds. It's always been one or the other. So what does it mean when both are rising at the same time? It means 2 completely different groups of investors are operating on 2 completely different time horizons simultaneously. Short-term investors looking at quarterly earnings, AI productivity gains, and stable employment data are buying stocks. The near-term economic picture looks reasonable, and they're positioned accordingly. Long-term institutional players, central banks, sovereign funds, generational capital are looking at government debt levels above 120% of GDP, increasing financial system volatility, and growing geopolitical unpredictability. They're positioning defensively for a future that may look very different from the present. Both groups are rational, they're just playing different games, and gold is where those 2 timelines are colliding in real time. If this kind of analysis is what you want every week, subscribe right now. This is exactly what we do on this channel. There is one more layer to this story that makes the price movement make complete sense. The total value of all gold ever mined in human history is approximately $15 trillion. Compare that to global stock markets at $100 trillion and global real estate at $300 trillion. Gold is a tiny market. When central banks, institutions managing trillions in reserves, decide to shift even 2 or 3% of their holdings into gold, the impact on such a small market is enormous. Prices move significantly on relatively modest institutional flows. And unlike stocks or bonds, you can't simply create more gold. Global mine production is around 3,500 metric tons per year, and that number has barely grown in a decade. Ore grades are actually declining, meaning it's becoming harder and more expensive to extract. Rising institutional demand, fixed supply that cannot respond quickly. The price math is straightforward. Let me be completely clear, this is not a call to panic or to abandon your investment strategy, but there are 3 things worth seriously considering. First, the classic investment portfolio needs rethinking. For decades, a split between stocks and bonds was considered well diversified. That relationship broke down in 2022 when both fell simultaneously during an inflationary period. Gold is one of the few assets that carries no counterparty risk and does not depend on the financial system performing well to hold its value. Having zero allocation to it in a shifting global environment may be worth reconsidering. Second, watch what major institutions do, not what they say. Central banks will never publicly announce a loss of confidence in any currency or system. That would be diplomatically catastrophic. But their balance sheet decisions are public record. When the most sophisticated long-term investors on Earth are consistently moving in one direction, that is information worth paying attention to. Third, we're in a transition period, and transition periods are slow, messy, and full of opportunity for people paying attention. The global financial system is not going to change overnight. This shift will play out over decades. But the investors who build wealth through transitions are not the ones who predict the future perfectly. They are the ones who build resilient portfolios that can handle multiple possible futures. So let us bring this together. Gold is not hitting record highs because of short-term inflation fears or a single geopolitical event. It is hitting record highs because the incentive structure that held the global financial system together for 80 years is slowly shifting. The world's most sophisticated institutions are not panicking, but they are hedging, quietly, persistently, month after month. When the largest and most informed financial players in the world all start moving in the same direction over an extended period of time, that is not noise. That is a signal. You do not need to become a gold enthusiast to take this seriously. You just need to understand what is happening and why. Because the people building wealth through major transitions are never the ones who ignored the data. They are the ones who saw the shift early, understood the incentives, and positioned themselves accordingly. The dollar is not disappearing. The financial system is not collapsing tomorrow. But the era of unquestioned absolute trust in any single asset or system is quietly ending, and gold is simply the place where that reality is showing up first. Subscribe for more. Every week we break down exactly what is happening in the financial world and what it means for your money. Share this with someone who needs to understand what is actually going on. See you in the next one.